Hello, everybody. Today is Monday, January the 15th, 2024, and it's the start of a new year, 2024. I'm John Blank, Zacks Chief Equity Strategist and Chief Economist, and today we're going to do part one of Zacks Asset Allocation. I write the monthly asset allocation and strategy report for the company. It's our masthead publication on Fidelity and other places. And this is part of helping you through the asset allocation process itself. So it should be understood today that I am tying this set of PowerPoint presentations today and down the road to our monthly strategy report. Keep that in mind. It's a resource that I'm creating and my team is creating for you, so you can use with that report as part of enhancing your returns and understanding of what we're doing. So part one will be the written summaries of asset class definitions. Part two will be asset class charts with their annualized returns. Annualized returns are critical, and I will be highlighting that. Part three, I will incorporate risk metrics into the major asset classes, of course, stocks and bonds particularly. So let's get going. First off, of course, we need the written summaries of asset class definitions. Of course, everybody knows some of the language here, but we need to make sure it is uniform from me to you and across other groups of people out there talking to you about asset class and asset allocation. So, broad asset classes, along with their classifications. So, as you can see here, all these are asset classes, and now we've got 6 in particular that you can choose from. This one, ETFs, is in some respects part of all of these because the ETFs are incorporating some of these. But we've kind of come up with a strategy today that allows equities that are individual equities and bonds that are individual bonds and mutual funds to be separate from ETFs, which, as you can see, can be equities, bonds, commodities, or currencies. So keep this chart in mind. We've got, for example, equity markets are typically based on their market capitalization. So it's mega and large cap stocks, the very, very big numbers for market capitalization. Mid cap stocks, which are typically below 5 billion, but above 1 billion, and then the small and micro cap stocks. Bonds, of course, it's based on the issuer. So government bonds, corporate bonds, municipal city bonds, or international and emerging market bonds are how we do bonds. ETFs, of course, go across these broad asset classes. They can basically be substitutes for individual stocks in these two areas or individual bonds in these two areas. Commodities, these are based on the raw materials or end product. So we have agricultural products, energy, and metals in our commodities area. Real estate, that's based on purpose or use. Again, government, commercial, or residential real estate. Foreign exchange market based on tradability, liquidity. Of course, these are the big ones. That's what we look at: US dollar, euro, yen, and pound. They're just basically tradable. Obviously, there's a lot of currencies out there, and you can use anything, but they're not as tradable. So, 7 characteristics or features of an asset class. What is it exactly? First of all, the composition of the constituent units in a specific asset class should be stable and measurable. Stable and measurable units. Number 2, these units should be directly investable. So you can put money directly on these units. Number 3, internal homogeneity. So within that asset class, they are homogeneous. However, outside that asset class, they're externally heterogeneous. They are different outside the asset class, but the same within the asset class. And they should contribute positively to the value of the portfolio. So they should not negatively contribute, they should only be positive. They should be cost effective and have liquidity, depth, and easy tradability at the lowest spreads, particularly for bonds. Manager selection should be 0. So, yes, you're supposed to be able to keep manager selection, people doing this. Obviously, in my market strategy report, people pay for it, but you should keep it down, right? You're trying to keep every cost down Spreads down, liquidity high, depth good, tradability easy, external homogeneity among cross asset classes, internal homogeneity within them, make it investable and make these units of investment stable and measurable. So that's what we're looking at. That's how we create from these asset classes using these characteristics. And now let's jump into the 5 steps in the formulation of a client's investment policy statement. So finalizing an investment policy statement for a client fund. This is something, if you know my market strategy report, there's a kind of a boilerplate chart that I do not change because really you need to do this with your client. The investment policy statement is critical. It's outside the scope of my market strategy report. So you have to have some domain experts or people who are talking to the clients and discuss their long and short-term risk and return profile. This is something have to be set up as an objective policy statement. So people have to sit down with the client and tell them, speak to them, work with them about what their risk and return. Of course, if you want extremely strong risk, you're going to be in equities. Less risk, you're going to be in bonds. Bonds are more important in a portfolio if people are older. So that's a discussion that always has to take place with the client. It is an individual thing. So it has to be objectives and goals for investable asset classes with constituents and the percent allocations. Percentage allocations for the individual risk and return. These are things that have to be set with the client, not within my report. So keep that in mind. Now, outside of that, what my report is going to do is give you corrective action all the time about what you can do within the framework for macro events. That is where number 4 is where I, in my report, offer some value. Number 5, getting it audited by a competent third party. So if you get this done, asset allocation, you might want to have a third party take a look at it, make sure your domain experts are doing their job. So what's the definition of asset allocation? Asset allocation is defined as the process of determining and assigning each of the asset classes, like equity, debt, commodities, real estate, and ETFs, a proportion of their core and specifying the risk and return characteristics. All right, so basically this all boils down to diversification. Maximizing returning and minimizing risk through asset allocation and diversification. The basic point here of an asset allocation thing is that there's a lot of risks out there, and you can minimize those risks by diversification across your asset classes. That's really all that you're doing here, and that's all that you should be trying to think about in a coherent way. So in this model, there are 3 types of asset allocation: strategic, dynamic, and tactical. Now, again, basically, the strategic allocation is very long-term. Long-term would be 10 years or so. Strategic is different than dynamic, which is you're going to make some changes relative to strategic allocation, make them fewer times than tactical. Tactical is very short time. So dynamic and tactical allocation is what my report offers. Strategic allocation is what you have to do for your client. This is always first. It's always longest term. But within that is this dynamic and tactical allocation that you can do overlaying onto this. So this is very long term. This is very short term. That's kind of how it works. All right. So asset class charts with their annualized returns. I want to point out, first of all, some of these lines go back to the 70s, some of the 90s. Here's one from 99, 2000. So the actual cumulative returns here are not very instructive. What is instructive is the annualized returns. Annualized returns are what you can expect for your strategic and asset allocation. Remember, we went back here. Strategic allocation is long term. And again, 10 years is the number, but this on an annual basis, this is what you can expect year in and year out. So mid cap or small cap or all growth, 11 to 10%. You're going to see that number is basically what you should expect. Micro caps, you think you're doing well. Recently, they haven't done that well, 7%. And actually, the mid caps have been, over time, the sweet spot. You can see that's 12.5%. Keep that in mind. Over here, you've got the Dow Industrials at 11%. Of course, not too different than the mid caps, about a point. Utilities don't do as well. Annualized returns at 9%. The Wilshire 5000, that's all of the capitalizations. That's 10.4%. And over here is the world stock markets, global, emerging, world, EFA. And as you can see, these lately have been done very poorly. This is something to keep in mind. It may not always be the case going forward, but the actual allocation to international stocks has been a poor decision for some time now. And it has been basically US-based equities that have given you those double-digit annual returns. All right, so these ones are real estate, muni bonds, and treasury bonds. Here's real estate, there's muni bonds, and there's treasury bonds. And again, real estate, depending on which one you choose, can give you a, even an infrastructure package, 13% for this Alarian. So keep in mind that there are choices here. There's the NAREIT Real Estate 50 that does well, and then of course the Global ex-US. Of course, once again, outside the US, we just don't have the performance here. Over here, you get the muni bonds when you just got to see basically this is something that's going to offer you 4 or 5% a year, no matter what. That's the guarantee here. These are basically 3 to 6% a year for treasuries. So those are obviously less than this, but they're more stable. All right, so domestic bonds. Here's domestic debt, international debt, and corporate debt. So if you want a little more return in bond land, you got to go into the global bonds, particularly emerging market sovereign bonds offer 8.5%, 9%. Keep that in mind. And over here, down here, you've got domestic master bonds. Longer term bonds offer a little more than shorter term bonds. 1 to 3 years are down at the 3.2% level, and the 10 years out at 5.5%. So again, here's the tickers for our systems where you can look these things up for your asset allocations. All right, so ETF-based asset classes are in here. And again, these are IVV, IWV, and IWN. Those are the tickers. Again, I put this over here. Keep this in mind. And then you've got the names of what we're looking at. These are all dividend adjusted. And you can find out whether you can get some returns out of this. Of course, oil and energy has done really poorly. Currencies are not a great trade. Municipal bonds have not been the great thing, although they are stable and offer cash returns. Keep that in mind. Of course, over here, equity ETFs on a dividend adjusted level can get you almost 14% if you do it right. So keep that in mind. Keep that in mind. All right. So 4 more ETF-based asset classes. This is aggregate bonds. Here you get the treasuries. Here you've got the energy again and gold. And down here you've got your REITs and ETFs for real estate. So again, keep these adjusted annualized returns and these tickers in your mind and resource these slides. As always, these charts are what is really important to get for the detail of the tickers and the returns. Obviously, it's kind of small print, a lot of information. That's why we want you to get a hold of us and give us the chance to give you these slides. They are the key thing. All right, one last subject today before we move to part 2. We'll be incorporating the risk metrics into these asset classes. Risk, obviously, and reward are the 2 big subjects, but just risk itself is worth discussing. So over here, you've got the Vanguards. Down here, you've got the American funds, and over here, the F will be Fidelity. So keep in mind, these here are going to be Vanguard funds of various types, and you can type these in and find out what they are. Over here, you've got 3, 5, and 10-year beta, stock market beta to the overall stock market, and Sharpe ratio, which I have put over here. What a positive Sharpe ratio, a 0 Sharpe ratio, or a negative Sharpe ratio means. This is risk-adjusted returns. As you can see, these are higher, longer, and shorter for lower-term things. But as you can point out here, you want to look at the Sharpe ratios, and you want to look at the betas most of all. And that's why I put these together. So as you can see, over 5-year periods, you can almost get to a 1. But over 10-year periods, you get a much higher level. So your risk-adjusted returns always go up over time. Keep that in mind. This is a game you can play. Just stay with your allocations over longer term horizons. You get a better Sharpe ratio. Beta, of course, a lot of people think they're getting in and out of beta. And I just want to point out that, basically higher or lower beta here's one in the 0.7s, and the highest one's 1.07. Here's a 0.6. The range is not as great as you think. And that is something to keep in mind here. There really is, you're stuck with the market risk as a beta factor. And only when you get in these lower beta ones, but can you find some way out of it? But it's not as much as you probably think. All right, diversified mutual funds. Again, here's Vanguard's municipal bonds. And here again, you can see that over the last 5 years, almost a zero Sharpe ratio for municipal bonds because of the way interest rates have moved. However, 10-year, again, you do very well. 10-year Sharpe ratios are very high for most of these instruments. Betas for bond funds are frankly quite close to 1. Again, the one that's different here is the muni bonds. They are the only thing, if you hold them to term, that gets you down in the beta. So keep that in mind. That is why people buy municipal bonds. They are really the one thing that's not as well correlated as everything else has been. Correlation of asset classes is going way, way up. Keep that in mind. All right, weightings. So over here, I've got FXAIX. That's the Fidelity 500. Over here, I've got FCTDX. This is Strategic Advisors Total U.S. Stock Fund. And down here, I've got AGTHX, Capital Group's Growth Fund of America. Now, why did I choose these? Tech weighting of 37% here for Fidelity 500, only 11% in the total stock fund. And down if you're American funds, if they're looking for growth, they're at 46% tech, and large growth is where they're looking for. That's your mega cap story. So over here, I've got all the different tech weightings. Really, it's tech versus everything else. I mean, really, it's what's come down to really is asset allocation, is how much tech exposure you want. It's pretty 11 to 36%. As you can see here, 36% is typically the norm. And now down here, these are just be broader funds that are outside of these groups, but large growth and tech are now kind of correlated, as we all know the mega cap story. So I put over here just where large growth and all these other types of styles are. So here you've got sectors, and there you've got styles, and here you've got all the ticker names and the asset under management. So these are very, very big funds: 94 billion, 112 billion, 600 billion. Keep in mind, these are the really, really big ones. Okay, so Moody's, Fitch, and S&P rated securities. Here's my diversified mutual funds. Here's my municipal bonds. Municipal bonds, of course, typically are AA or A rated securities. And over here, you can see U.S. government is either, all these are for the most part, AAA rated, although some of these are much lower. Here's one that has lower rated. This is probably M, I would have guessed would be mutual fund bonds in here. More of them. So keep in mind that there is a risk profile to want. You do not want to see the double Bs or Bs. Some of them, though, triple Bs, that's where the high yield is. So this will be a measure of high yield when there's more of the triple B percentages in a fund. This would be one that you would expect to find that. Okay, thanks for attending. I hope you enjoyed this. There will be a part 2 on asset allocation, but as I said before, this is really about the charts. Get a hold of these charts, 866-794-6065. Better yet, just give us an email to strategycall@zackspro.com, or go us onto the web and find out www.zackspro.com and get a hold of these charts from us. There is no way to get the detail, particularly in an asset allocation framework, than to have these charts and go through with your advisor at Zacks what they can tell you in terms of finding the way from our slides to our website and all the other information we have. We have a LinkedIn page at Zacks Professional Services, and on Twitter, we are at ZA Tools. I hope you enjoyed this, and it's going to be a part 2 to it, so keep in mind, look out for that in a couple weeks.